Hi there guys, and welcome to this week's edition of the Wise Crypto Sunday Special with me, your host Chris Coney. Today we'll be discussing the various ways in which you can protect your crypto assets using DeFi derivatives. So this is not protecting your assets from hacking or theft or anything like that. That's a conversation about security. What we're going to talk about today is more about protecting the value of your assets using various derivatives, and maybe we'll talk about some centralized derivatives, and then we'll talk about how you do that in a decentralized way with DeFi apps and so on. So today we've actually got a full house today. I've got all three analysts in the house. So first of all, we've got Alex Benfield. Alex, welcome back to the Sunday Special, mate.
Hey Chris, thanks for having me back again.
We've got the lovely Marija Matic back on the show. Marija,
thanks for having me, Chris.
And we've got the master, Juan Villaverde. Welcome back, mate.
Good to be here, sir.
Alrighty then. So I'm going to open this up. So back in the day, when I started my first business, I used to listen to, and I haven't listened to him in a while, Jim Rohn, who's like a motivational speaker. And I remember specifically from one of his audio programs, he used to talk about ants, as in the insect. And he would say that ants think about winter all summer long, and they think about summer all winter long. And he says you can see this in their behavior. They never get faked out by what's actually happening with the weather. When it's sunny, you can actually see the ants frantically collecting and storing food because they know that winter is coming, even though the sun is shining brightly in the sky and they could be sunbathing instead. They don't do that. Conversely, when it turns to winter, they don't despair, A, because they're prepared for it, and B, because they know summer's coming back soon. So with that in mind, I thought, let's start thinking like ants. Even though crypto prices are going pretty well right now and the sun is shining bright, what can we be doing, right? We can start thinking about is what can we be doing to protect our assets for if and when the crypto winter befalls us. So I started thinking about this when I came across this new project called Bumper, which is basically an insurance fund where you insure your Ethereum first and foremost against downside volatility. So if you insure your Ethereum and it goes up, you get the price appreciation. If you insure your Ethereum and it goes down, you claim on the insurance and then get the value that you insured it for, just as if it was a car. And then I went looking for some others and found antimatter finance and a few others. But let's start chronologically like I normally do. So I'm going to bring you guys in now. So before the DeFi revolution, like Juan's been a traditional trader, and so he might have some more fundamental universal principles on this. But how do people traditionally hedge against downside volatility? Juan, you start that, and then we'll go from there.
Traditionally, using futures. I think futures go all the way back to Babylon. So really? Thousands of years. Yeah. The first like mainstream way to hedge assets is through futures, which is basically that you fix the price of an asset. Mm-hmm. And somebody can fact check me on this, but options were either invented or became super popular in the early 20th century in the United States. So it's something that became a thing in the US capital markets. And options are, like you said, bumper finance, antimatter. Options are interesting because they allow you to participate in the upside, but they cap the downside of your investments. Now, the flip side of that is there's always, you'll have to pay in order to get that service, of course. And it can be expensive if you're always buying insurance just in case something bad happens. Sure. But the good thing about options, and before I was into crypto, I was mostly an options trader. I would dabble into futures. Actually, I would do options on futures. So I would dabble on futures markets as well, but I was mostly doing options on futures and option strategies. And so I know them very well, and I know how powerful they can be, both from the long and the short side. You can create a lot of income as a seller of options, a seller of insurance. You can also, make a fundamental difference to your portfolio if you buy them for protection. Yeah.
So I'm thinking back 2017. I'm talking to my friend Simon as we are nearing the top, right? And he starts talking. I think he might have even done this. Like, I don't know if he actually did it or not. But in terms of hedging the downside, he was like, well, let's just say someone has 100 BTC and they think it's the top, right? So Simon was saying, well, all you do is you take a tenth of that. So you take 10 Bitcoin, put it on deposit with BitMEX, take out a short position and leverage it 10 times. What that then does is every tick down, every 1% tick down in price, you've got 10 Bitcoin, 10 times leverage offsetting the devaluation of your 90 Bitcoin, right? Does that make sense? That's like a very basic strategy.
It does, but what that does is create what Arthur Hayes, the founder of BitMEX, calls synthetic. Actually, he doesn't call them these. He calls it, I don't remember the name. He has a funny name for that, but it's synthetic dollars. Right. You basically sold your Bitcoin if you do that. If I have 100 Bitcoin and I sell 100 Bitcoin using 10 Bitcoin on BitMEX, so I lever up 10 times, my net Bitcoin position is zero.
That's the key.
What I have is synthetic dollars.
That's
so
the key.
I still have Bitcoin, the asset, but it doesn't move in price.
That's key.
I have it's a synthetic dollar.
So it depends whether you are accounting for your returns in USD or BTC.
Correct.
Right.
Correct.
Cool. Let's pass the ball. Alex or Marija, do you want to jump in? Have you got any comments on this? Traditionally, how you would hedge your downside risk?
Yeah, you can go ahead and take that if you want.
If not, we'll move on to the next point. It's fine.
No, I agree with Juan. Like options and futures are very useful, both in traditional and in the crypto world. But what's interesting that the crypto world is now reinventing the wheel by making it decentralized, by making the other side, creating more participants in the system. And so it's quite interesting. But besides these like antimatter and things, there are other things that people do to hedge risks, because it's not just about having certain assets. It's also about if you're using it in DeFi, if you're loaning your assets, if you are, you are prone to liquidations due to the price drop of your collateral, things like that. There are many ways to kind of hedge your risk outside of just holding the crypto or trading it in a traditional way. So we can speak about that later. So Alex, if you want to jump in as well.
So let me talk about Bumper for a minute, because this is kind of timely and it's sort of my current obsession, if you like. So and Juan sort of took the wind out of my sails a little bit by saying, "Oh yeah, they're not doing anything new. They've just taken options and made them super accessible as a product, right?" Which is basically what they've done, right?
They changed the contracts too, which is to Marija's point. What's interesting to me, coming from traditional markets, is that these contracts are new. They did not exist before. Before crypto, there were no perpetual futures. It was just not a thing. And now Bumper Finance,
they had an expiry date.
Yeah, these are more like swaps where you enter into a contract with someone and you pay them a fee like every hour, every day, and then you have this permanent protection. And again, I don't want to get ahead of myself because this is super interesting. These are tokens that can trade on exchanges, so like on decentralized exchanges. So you could compose on them.
What do you mean? What are tokens that can trade on decentralized?
I mean, I can buy a perpetual option. I can mint a perpetual option on
antimatter. You can do that
on antimatter, and then I can trade that on Uniswap.
Correct.
And because this is an ERC20 token, I can actually create contracts that use those contracts. This stuff does not exist in traditional finance. It just doesn't.
Well,
you can't do this.
Are you sure? Because
100%. You don't have programmable money, so you can't create applications that use complex derivatives to do other applications.
But I mean, like when they talk about financial weapons of mass destruction, and if you look at Demonocracy, it shows that massive upside down pyramid of derivatives upon derivatives upon derivatives that would, which is the upside down Ponzi scheme that the system is based on. So isn't that similar in the sense that you've got derivatives of derivatives of derivatives?
The key difference is that each building block tends to be more secure in crypto, because remember that the part of the traditional system that almost collapsed was the obscure, unregulated, non-listed,
opaque,
over-the-counter, opaque, dark pool money that was just trading these derivatives. And they, for the most part, they didn't know who the counterparty was.
Yep.
So I had a contract with someone, let's say I have an option, a swap, and turns out the counterparty is bankrupt. Right. So I think I'm hedged, but I'm not. This is what happened. The market just broke down. Market structure just broke down. And I think crypto is just fundamentally because everything is over-collateralized. And as long as the base layer is properly collateralized and that collateral is managed accordingly, you can build on top of this, and it will be relatively secure. To prove that, I mean, we've had 50% crashes in a day in crypto, and the market keeps going. So where's that systemic risk? It's just not there.
Okay.
Right. If I can jump in,
Alex,
so I think the key difference, in my opinion, here is that these crypto markets are significantly more transparent than anything we have in traditional finance, right? You can literally tell who's holding the asset, who's controlling what contract or whatever. There's absolutely none of that in traditional finance, or at least you have to be an extremely sophisticated market participant to be able to track positions, right? I mean, these aren't reported. These aren't in databases that you can scan instantly, like Etherscan or something like that. So honestly, the transparency is a real game changer, right? That's a big differentiator.
I'm thinking about this scene in The Big Short. I think it's in The Big Short. It is in The Big Short.
Great movie.
Great movie.
It's amazing.
Yeah.
And who's the guy? Evan Almighty. Who's that actor?
Steve Carell.
Steve Carell.
That's the guy. So he's talking to the issuers of some of these collateralized debt obligations, and that's when it dawns on him that the system is just screwed up the yin yang, right? And this, I think Juan just kind of made a breakthrough there in my thinking, is that the trouble with CDOs and things like that is they contain toxic assets and people didn't know about it. When US municipalities were investing in these things, they obviously got totally hoodwinked by Wall Street traders who knew how to sell, and these municipalities just saw dollar signs and whatnot and just invested in these things, but didn't know what a toxic asset was, whatever. So what would you do? Well, traditionally, you rely on, I don't know, agencies like Weiss Ratings to rate these things, but in crypto, it's sort of like you don't need that because it's fully collateralized, number one, and those values are shifting in real time. So the solvency or insolvency of a particular, let's use CDOs, is verifiable every 15 seconds. True or false?
Yeah. Right. I think that's back to the transparency issue. And I'm still laughing at the fact that
You're still laughing.
You quoted Steve Carell from Evan Almighty and not maybe like The Office or The 40-Year-Old Virgin. Or
I'm sorry.
True. I was thinking that too.
I'm so sorry.
No, back to the transparency issue. Right. Every block you can check some of these holdings in cryptocurrency, right, just by scanning the blockchain. But when traditional finance, right, you have to wait for like weekly reports or something. Like I do think all this information is publicly available when it comes to traditional finance. It's just way harder to get your hands on, and it's not live real time.
And it's not based on smart contracts. It's not based on rules that you cannot break. Actually, if you're insolvent, you can call someone at the Fed and give you a credit. It's just so much more analog. It doesn't work that way. Like in crypto and DeFi, insolvent players get liquidated automatically, period.
Right. Well, it's a trust versus a trustless system, right?
Yeah.
So there's no trust in crypto, but there's plenty of ways you can get around rules in traditional finance.
I was reviewing some of the DeFi. Go on, Marija, go for it.
Can I say something? I mean, there are volatility risk related to loan collateral in DeFi. So if you want to take out a loan, you can do it immediately in seconds, but lending protocols usually require users to over collateralize, which is good. Their loans upwards to, 150% in order to secure the stablecoin loan. But because the collateral is very, very volatile, this opens users to a risk of liquidation should the value of their collateral decrease. But there are hedges, there are ways, there are smart contract automation platforms that can allow users to automatically replenish collateral if the value decreases to avoid liquidation.
Good point.
So, but on the flip side, also, users can rebalance their collateral as the value of the collateralized asset increases. But currently, there are efforts. For example, DeFi lending protocols are building credit risk protocols for users to borrow under collateralized loans. So right now, crypto is over collateralized primarily, but there are trends to go towards the, credit risk protocols where you have a credit score based on your blockchain ID, identity, and behavior, and based on the behavior of your address, wallet, and things like that. So there are things that are moving in the direction of under-collateralized and more like traditional, but still it's very important that there are ways, and as Alex said, transparency and also automation that are reducing risks of volatility.
I think that's okay, even if they're under-collateralized. It just sits on the spectrum of risk, doesn't it? They would just be higher risk. And if you want 100%, 150% collateralized assets, they'll be there. The whole suite of stuff will be there, so you can just take your pick. Now,
that is true.
Marija just said something about...
when we are talking about collateral, I would say, like when you say toxic collateral, I would consider toxic collateral to be, for example, what is placed into DAI contracts. Into like MakerDAO, a stablecoin maker, which produces DAI stablecoin. So if it's collateralized, it was first collateralized only with Ethereum, which is very high value, very liquid, very important crypto. But then it got multi-collateral with different currencies, and when it came to that part, it became kind of, in my view, a little bit more risky because I don't want shitcoins in the collateral. And that's why it's important to monitor all these very important building blocks in money Lego system. As Juan said, this is all about composability. It's not really about putting toxic on top of toxic. It's more composability, how composable they are. So stablecoins are a very important part of this composability. And so just kind of realizing which are the key components of these DeFi blocks is very important, and to keep track on them and warn users if there is something not quite right.
Yeah, on that note, what I would say is that even though there is risk for the individual to participate in these systems, because to Marija's point, these positions tend to be over-collateralized. When your collateral falls under a certain threshold, you're going to get auto-liquidated. Basically, the contract has a mechanism to seize your collateral and repay your loans. DAI is one such example. But what I would say is that because the system is so good at managing individual risk via smart contracts, the system as a whole tends to be more robust. There are no systemic issues that we know of in DeFi. Now, DAI is a very good example because back in March 2020, there was this moment where DAI became, for a while, under-collateralized because the Ethereum price fell too quickly. And so there was more DAI debt than there was collateral. And everybody was calling for the death of DAI. That's what prompted them to have to be multi-collateral. Whether or not that's a good solution is a different debate. But the system survived. I think that's the key point here. I mean, it survived. It went through that massive liquidation event, and DAI, after experiencing some volatility, remained somewhat stable.
Do you mean with no external intervention?
Well, you could argue that the devs came in and said, hey, let's initially, I don't know how many assets they accept now, but their knee-jerk reaction was to say, hey, let's back our stablecoin with more stablecoins. And let's suspend the rules for the stablecoins. In other words, you cannot get liquidated for a stablecoin loan. Like if I deposit USDC on DAI and I create DAI and USDC for some reason fell below $1, the smart contract doesn't recognize that. So it lets me keep that loan. So you could argue that that's a bit of a quick patch solution, not really a sustainable solution, but it's not easy to back a stablecoin with assets that are as volatile as crypto.
That's the problem, right? Yeah, exactly. And that was the thinking behind making DAI into a multi-collateral asset in the first place. While Ethereum is the obvious choice, liquidity, market cap, all the things, it's the volatility. You'd still need like 400% collateral to absolutely guarantee that it was always going to be solvent.
Yeah, pretty much.
So, Marija,
but still, I mean, crypto is very correlated. The prices of crypto are quite correlated with each other. When the market goes up, almost all the crypto goes up and vice versa. So right now, multi-currency collateralization doesn't really protect it from black swan events.
Mm-hmm. You don't want to go there, but you're right. That's absolutely the case.
But it's a very, very tough code and battle tested. As Juan said, we had some very serious events and it survived it. And there are some very, very diligent people who are participating as, some kind of participant, whether they are minting or doing this or that. So yeah, it's a very robust system and I'm quite satisfied with DAI.
So let's segue into DeFi derivatives, because I think this could be a solution for DAI. Is what if you throw things into that mix that are negatively correlated to price? In other words, assets, crypto assets that go up when the price of crypto assets go down.
Right.
And actually, I was reading up on, I think it was called Tracer DAO, and they're working on these. It's kind of a complex way of creating leverage tokens, leverage bull and bear tokens. So they want to create leverage ERC20 tokens that have leverage but cannot get liquidated. So they go into how they create this synthetic leverage. But it's quite interesting because the bottom line is, here's this ERC20 token that basically is a claim on a pool of assets. People pool assets together and you can take a bet long or short. Bottom line is this: you can buy an asset that will go up on leverage when the price of crypto crashes, and you can back DAI with those leveraged short ERC20 tokens. So this is the magic of composability. Now I can back a stable coin in such a way that I could create some stability by creating a good mix of assets that are negatively correlated to one another.
We've just described antimatter.
Antimatter is one such yeah, you're right. I mean, the whole DAI pool could be hedged for all we know.
Because
just buying options on its own pool of assets.
Because on Binance have those leverage tokens like BTC up and BTC down.
Yeah, these are different though. These are on-chain.
That's exactly my point. That was exactly my point.
Right.
And in the opening, we're talking about, yes, all this stuff might not seem like anything new under the sun, and this is the subtlety of describing DeFi. People are like, oh yeah, I've heard all this before, but not in a decentralized way, autonomous way that can't be messed with. So Binance have BTC down, and if you buy that asset and BTC goes down in price, the value of BTC down goes up, right? It's just a weird thing, which is good because people are used to buying low and selling high, so that helps.
I was just having this conversation yesterday, actually. We're inevitably going to replicate the entire traditional financial system through DeFi, right? So right now we have, options, derivatives, futures, plenty of different things that have already been replicated in a decentralized fashion, using smart contracts on DeFi protocols. But every aspect of the traditional financial system will end up being replicated over DeFi. And so you're right now talking about the benefits of, how decentralization actually improves some of these things. But we're probably still kind of in the infancy stages of DeFi right now. And we're going to see everything under the sun that happens in traditional finance replicated again over the blockchain, right? So you're talking about a little bit of the worries of bad collateral or derivatives built on derivatives. We don't have that yet in DeFi, but something tells me we will eventually replicate some of these things, but risk will be mitigated via smart contracts and decentralization. And hopefully we're able to replicate those aspects of finance in a better way.
Here's the question. How on earth, I'm going to talk about Bumper again, how on earth does it stay solvent, right? Because if it is a system that has no intervention from external parties, then a traditional insurance, say car insurance, right? I have, say, a $60,000 Porsche, and I take out an insurance policy that's worth $60,000 against that car, and it's $1,000 a year, right? Boom. That goes into the insurance pool, right? And the insurance company who's taking on that risk is hoping to God that at least 60 customers pay $1,000 a year into the pool, and the Porsche crash ratio is only 60-1 or better, right? Because they're going to have to pay out $60,000 to replace that car. And if 2 out of 60 people crash their $60,000 Porsches, it's insolvent, right? So that's that. Now let's take it over to crypto. Let's say back in 2017, Bitcoin hits its $20,000 all-time high. Let's say Bumper existed back then, and I had an insurance policy out on my Bitcoin, right? The difference here is that everybody crashed at the same time. All the $60,000 Porsches simultaneously got written off, which means all the Bitcoin holders had a loss of value. It crashed. So in that instance, not everybody, because not everyone would have insurance, but a ton of people would then claim insurance on their crashed Bitcoin, right? So
this gets to the issue of collateral, though. I mean, this is an issue of individual collateral. The people who are selling right now on DeFi, I haven't looked at Bumper specifically, but I'm guessing it's over collateralized. Meaning, if I sell someone insurance to buy one Bitcoin at $40,000, they'll want me to have the $40,000.
Yes. Well, actually, it's a two-sided marketplace. So never mind, I'm the insurance buyer. On the other side of it is someone that has USDC and puts it in the pool for a yield.
Yeah, for yield. This is a way to create yield. Why would you do this? Yield. And in fact, I'm thinking of doing it. Once these perpetual options become popular, I'm thinking of doing them with some of my crypto assets, especially when prices go up, because chances are when prices go way, way up, which I'm expecting will happen as we head towards the end of the year, these insurance premiums, or rather the amount people are willing to pay to buy Bitcoin, say at 100,000, 150,000, whatever, is going to be so high that Bitcoin holders will be incentivized to sell these contracts and say, hey, in exchange for this fee, I'd be willing to let go of my Bitcoin at, whatever, 250,000 in exchange for this fee every hour. And so this is just a way of creating income based on the assets you hold and the prices you would sell at anyway. I'm not saying that I would sell at 250 or whatever, just an example. If you see the market getting overheated, chances are, because why would people buy this insurance? Remember, you can buy these options without having the asset to insure. This is not just insurance. This is also a way to speculate. I can just buy this contract from someone because I want to place a leveraged bet, which is why I don't know if Bumper does this, but Antimatter does do this. They compare themselves to a way of buying leveraged tokens, because I can buy these options on Bitcoin at 250,000 call options right now, maybe today, and chances are I'm only going to be required to pay a very small amount for these contracts. And if Bitcoin were to go up,
well, the closer it gets to that price, the price of that contract will go up. That's a way of placing a leveraged bet that Bitcoin will go higher. And my downside is limited. This is the beauty of options. My downside is limited. I can only lose what I paid for that contract. I cannot lose more. Just like if I don't claim on the insurance on my Porsche, if I don't crash it, right, then I just lose the $1,000, but I don't lose it. I've spent it.
Exactly. But imagine buying insurance on someone else's Porsche. This is what we're talking about.
In case they crash it.
In case they crash it.
Alex, I'm looking at you, Alex.
Think about the incentives that create.
Please show me these $60,000 Porsches, and I will.
It's an old one. It's an old one. It's a Porsche Cayman. Anyway, not that I was suggesting that Alex is the one most likely to crash the Porsche. I was suggesting that Alex is most likely the one to own a Porsche. There we go. So,
that's probably true.
Okay, cool. So we've done.
I think. Sorry.
Yeah, go.
I think insurance protocols that are insuring against the volatility of stablecoins are also very interesting. Since stablecoins are, supposed to be stable, but in case of some event, for example, if you find out that maybe Theta is not collateralized enough to cash in the banks, or USDC suffers some regulatory issue, or DAI has some larger movement of the price due to the movement of the collateral, then and you hold the DAI USDT or some other stablecoin, you hold a large amount, you may want to insure yourself until certain dates, until you are planning to hold that stablecoin in your hands. So, for example, you can go to the decentralized pools, decentralized protocols, where individuals are, giving their money, putting their money in the pool, and selling the insurance. That pool is selling the insurance for a certain fee to someone who wants to get insured against for example, price drop of 5%. So if the price of Tether, which is supposed to be $1, and most of the times, goes below 95 cents, then I want the insurance to cover the rest.
Interesting.
If it goes before the certain date. So I think these stablecoin insurances are much easier and much more kind of and easier also for a usual retail investor to understand that this is also part of the DeFi. So on top of providing liquidity to the centralized exchanges with automated market making models, on top of lending your money on Aave or some other lending protocol, there are tons of other options that you can do different things. You can also provide insurance against, for example, the drop in price of a stable coin until certain dates, things like that. So I think with stable coins, it's much more easier to understand for a regular people than with the volatile coins.
That's a good one. That is a good one, because say whenever I explain stable coins to people and they say, oh, they're always backed by $1 in a bank account somewhere, the next question is like, well, that's still a risk though. So what if Circle, the backers of say USDC, suddenly get a regulatory rug pull, and then USDC loses its regulatory approval or is found to not have the collateral, the backing for the right, then USDC would then lose its peg, right?
It would lose the peg. Like for example, in the case of DAI, it would probably be like DAI cannot be regulated, but it can lose the peg due to the change in price of the collateral, and it can lose it, I don't know, short term, up to 5%, maybe, and so yeah, in those cases it's quite interesting. But those that have systemic risk, higher regulatory risk, or they need to have cash in banks which are collateralized with cash, those have certain different risks. But still, as you say, the unpegging is somewhat a risk, especially if you need to hold a certain stablecoin until a specific date.
Yes. So what I find interesting, which is different in the DeFi world versus, say, traditional options and insurance and so on, is in the case of Bumper again, a large part of the token supply has been allocated to protocol use. So that means, but that boggles my mind though, because everyone's going to be paying their insurance premiums in the Bump token, and then I suppose the USDC stakers are going to be earning their yield in Bump tokens, right? Okay, but then at the same time, in the insurance pool, the protocol's got all these Bump tokens, which you hope would have a high market cap and high liquidity in the event of, you want to make sure there's enough capital there to pay out the insurance policies that get claimed on, which is weird because I'm still thinking about traditional insurance, car insurance. Everyone pays their insurance premium in the dollar or the pound, and then the asset is insured to a pound or dollar value, and then when it's claimed, it's pounds or dollars that are paid out. So that's, like Marija was saying, it's pretty straightforward to get your head around the fact that it's the same asset all the way through. In the case of like Bumpo and these decentralized options, you've got initially, Ethereum is the asset you're insuring, you're paying the premium in another asset called Bump token, but then the insurance pool is being provided by people staking USDC. It's like,
of course,
my goodness me.
Because what you're insuring here is the price of Ethereum in dollars,
correct,
presumably.
Yes.
So this is why now in my view, if you told me that, hey, here you can stake your USDC to sell this insurance to people so that in the future they can sell their ETH to you, and you told me that I'm going to be receiving that in bumper tokens, I'd be like, yeah, I'm not sure I'm so interested in that. But I want yield on my dollars. I don't necessarily want a crypto token.
That's the same old yield farming thing, which is when you get your premium, you can swap it into more USDC and compound it if you want to.
Well, right. I mean, a good mix would be fine. But if all I'm getting as a premium for selling this insurance is the bumper token, then I'm not sure I'm so interested in that. Because then you're adding this X factor.
Is it because you can't be bothered to go and swap it on Uniswap?
It's simply because I don't know how much I'm going to get. Typically, the reason investors want yield is because they want some certainty with regards to their income. And if they're getting a volatile crypto asset that they have, I mean, it's not that they have no certainty. They know they'll make something, but they can't reason in terms of how much can I expect? Because what if it says 10%, right? If it says 10%, but in bumper tokens, okay, if the price of bumper token is down 90% over the next year, then I got 1%. I don't want that volatility. The whole reason I'm parking my USDC and selling a contract is because I want stable yield.
Yes. So it relies on you taking your bump tokens in every payment and then flipping them into USDC quick before the price moves. Which
is why just pay me in USDC. I mean, this is how certain crypto derivatives work already. I mean, all of the most common derivative there is right now, both on-chain and off-chain, in other words, decentralized and centralized, is the perpetual swap. And the perpetual swap is, there's two kinds. Some settle in crypto. Some perpetual swaps settle in crypto. In other words, you have a Bitcoin. You can trade Bitcoin against the dollar, but the contract settles in BTC. Mm-hmm. So when the seller needs to pay the buyer, the exchange takes place in Bitcoin. Right. These contracts, sellers typically get incentivized to short BTC because they get a premium payment every 8 hours from the buyer. This is how these work. So how do you incentivize someone to sell a crypto asset? You pay them to do so. And the seller can choose to be paid in either Bitcoin or in dollars, depending on the contract. Mm. And so you have both. You can pick and choose. But if you're forced to take, and these are prime assets, right? It usually is the asset that's being traded. For example, if I'm engaging in a Bitcoin USD market, perpetual swap, I can either get paid in Bitcoin or in dollars. There's no third token. I would argue that there is a third token involved. That's actually a bad thing. And I have a good example for that. BitMEX which only accepts Bitcoin, try to do contracts that settle in Bitcoin but trade, say, Ethereum against the dollar. And these contracts are not very popular. And I know that because premiums on those contracts tend to be huge, meaning there's no one doing arbitrage. And if there's no one doing arbitrage when premiums are significantly higher than the market average, that means market makers are not willing to come in and make these markets. And the reason for that, I can only imagine, is that they don't want the added complexity of managing these positions. Right. So when you add a third token, because in the Porsche example, you're trading Porsche versus the dollar. It's a Porsche USDC pair. Right. So you can either get paid in Porsche or in dollars. But if you add a third token, I would argue that extra layer of complexity is something that puts people off.
You can't actually get paid in Porsches because the insurance company doesn't get the car for you and give you it. It settles in US dollars.
Right. So the analogy breaks down at one point.
Same with bumper, actually, because if Ethereum gets to $10,000 and then I take out insurance, like Marija said, and insure it for $9,000, right, for 90% of its value, and then the market takes a 60% dip. Okay, happy days. I'll exercise my option, and then it costs me 10%, right, plus whatever the premium I've spent, but it's better than 60%. However, as far as I understand it, I'll get USDC back. I get $9,000 of USDC per Ethereum. I don't get my Ethereum back, which is why at the beginning of this episode, Juan, you said in my BitMEX example, you're effectively selling your Bitcoin at that point, or in my case, I'm effectively selling my Ethereum. I'm agreeing, committing to sell my Ethereum at the time I take out that option, because I never get it back unless I get the USDC and buy it back.
Right. So I don't know if you want to go down this rabbit hole, but it is possible to settle the contract in Ethereum, for example, and what you get is $9,000 worth of ETH at whatever the price of ETH is.
Sure.
You can do this too. So if ETH is 9,000, you get 1 ETH. If ETH is 4,500, you get 2.
Well, you could program that in, right? I suppose.
You can program that in. So yeah, you can do that as well. And so when you do the synthetic Bitcoin, what happens is, which is quite interesting, is the amount of Bitcoin you have fluctuates so that you always have a fixed amount of dollars.
Yes.
This is, yeah.
Yes, and this is probably slightly mind-boggling because Uniswap provides a lot of that back end for all these apps, and I think Bumper are talking about that as well. They'll integrate with other yield farms so that the interest rate you earn from wherever you earn finance or whatever, they might be tapping the Bumper protocol for some yield and passing it on to their users and stuff like that. So there's this web of interconnectivity, which is all transparent. As Alex said earlier on, it doesn't matter how complex it gets, the auditability and accountability will all still be there, which is why that is a key distinction between rebuilding the existing financial system on these new rails. It's that transparency and accountability that is fine, even if that's the only thing that changed. It transform everything, right?
Right. I think all three of you are significantly better traders when it comes to derivatives and futures, options, etc., than I am. But this example of taking out insurance on your Bitcoin, the 90% insurance like Juan gave in the beginning of this shoot, I'm not experienced with options, but I'm not sure. You're talking about how, when you take that insurance premium, you're effectively selling your Bitcoin. Call me simple, but I don't know why you wouldn't just sell your Bitcoin, bake that, sell it for USDC or something, park that USDC and somewhere where you're going to generate yield and just already start making that yield. So instead of paying an insurance premium, you're making a yield.
So let me correct you there, my friend. If you're buying an option, like I say, if you're buying an option that's 10% below the spot price on Bitcoin, you participate in the upside and you can only lose 10%. In exchange for that, unlimited upside can only lose 10%. In exchange for that, you're going to pay a premium.
Yes. So
essentially, you'd go down the options route if you thought there was still a little bit of upside, but you wanted to protect against the downside. Right.
Exactly. So go back to my example of Ethereum hits $10,000, right? Instead of just making the decision to sell it for $10,000 and then that's it, I have to make that call, and I could be right or wrong. If I'm wrong and Ethereum doubles again, I've sold at 10,000 and I could have sold at 20. By taking out the option, right, I pay the insurance premium. Then if Ethereum doubles, I just don't exercise the option. I just sell the Ethereum at $20,000. If it falls, I claim on the insurance and get it at 9,000. So it's kind of win-win.
It's the best way to hedge is through options.
I usually solve this problem myself by dollar cost averaging and not selling everything all at once. But that meme where it's the parabolic curve,
yep,
right? And you have the dumb guy on the left side, you have the smart guy in the middle, and you have the guy in the hood on the right side. I think I'm like the left guy. I'm not the smart guy.
You're not the guy in the hood.
We're both doing the same thing. We're both getting the same results. You guys are thinking way further ahead than I am.
It's that IQ bell curve thingy, and the super dumb and super smart guy basically do the same thing, and it's the middle guys that are always losing.
I love that meme. Love that meme. But I use a lot of instruments though, and I don't like to think that I'm that stupid. But
you just don't want to be the guy in the middle, right? As long as you're not the guy in the middle, you're fine.
So I want to just close this one out with another comment from Marija. So Marija, when I was looking into all this, I thought, well, what else is out there? I ended up on CoinMarketCap, and they actually have this category for options, and there are 10 right now, 10 option-based tokens, one of which is the antimatter token. So just quick comment, don't mean to put you on the spot, so say whatever you want to say, but have you studied any of these from an investable point of view?
Not for Vice, but yes, I was looking at them. Especially antimatter was very, very popular. And I don't know. I think we are still very early, and I actually want to see them how they perform in the wild, and the volumes and the amounts that are going to be locked in those protocols, and all the systemic risks and game theory risks that may arise. And it's quite early. I think they will be very important in the future, together with the insurance protocols. And they're still not there yet, but certainly from investment point of view, I think it can be very interesting. But as Juan said, receiving, depends which coin are you receiving. If the token, I have to see if people really want to receive those tokens as collateral. And these are all kind of behavioral economics and game theories that we need to track a little bit more in order to go deep into. Also with the insurance tokens and projects, they're very nice ones, and but liquidity is not there yet, and also you have to track all the possibilities and how it's going to behave under stress testing, as we've seen with MakerDAO when it was stress tested due to market conditions. We are going to see with these projects as well. So maybe if you're thinking about investing, yes, you're early, but picking the winner, I think it's a bit too early to say. There are different things.
Not always great, right?
Not always. It can have comparative advantage, which is very important in crypto, but it's not always great. But it certainly gets battle tested first, which may kind of harden it first, like it did with Aave, or we will see. For now, we also have some in terms of kind of regulating volatility. We have these index tokens where you kind of disperse the risk by buying index of baskets of different projects, for example, related to DeFi or ecosystem like Solana ecosystem, or now Polygon ecosystem. And so these are also against, because if you don't know what to invest in, which exactly, there's so many DeFi projects, so many Polygon projects, so many Solana projects, you can simply invest in an index which tracks, which has a basket of the most promising projects. And there are people who are, always caring about which tokens are in the basket. So these are also for price risks in some way. So because the topic of this video is volatility, price volatility, and how to hedge. So there's so many topics around it, but yeah, so I think it's a very, very large subject.
You didn't say these exact words, but I just want to clarify something. So do you need to see a working product before you would make an assessment?
I'm, as an analyst, sometimes you are assessing pre-sales and different stages of the project, even just white papers. It's just, it depends. Like I have higher risk tolerance than regular investor, and I would invest on less information, but I wouldn't risk too much.
Gotcha.
So yeah, it depends on the purpose and the person.
Sometimes being too early is not any different than being wrong. One thing I would clarify with when it comes to investing in these types of DeFi protocols, right? Like different applications of DeFi, insurance, whatever. The way I would approach investing these is to check out what institutions are buying, right? Because these are people that participate in traditional finance. They understand it better than most people. And they're going to know what to look for and what makes a good product. So I don't think they're really getting too deep into those DeFi protocols yet. I could be wrong, but I would just monitor their portfolios. That's kind of how I would look to pick the winners of this space. Whoever's going to get the money from institutions that are already participating in that type of financial product, they're most likely going to be one of the winners from this new DeFi boom.
I'm with you.
Yeah, okay. Or you can just, for me, it's using the product. If there's no working product, I'm not interested. If they have a good product, recent example is DYDX. I'm not surprised they're doing so well. The token launch was recent. I think it was last month. Yeah, it was last month. And they're doing great. I think based on CoinMarketCap, I think they're the second largest derivatives. They have identified as derivatives token. And I'm not surprised because they have a great product. They always have. They were one of the early movers. I think they were the first ones to have like off-chain order book combined with on-chain settlement. I always thought, hey, this is a great idea. No one else is really doing. I mean, they are now, but not back then. And it's just a great product. It's a great product. So this is for me has always been, hey, if these people had a token, and a bunch of us were actually telling them years ago, you guys should have a token, because people would buy it. Because it's good. Just throw some governance features into it, and people will buy it. And now they're exploding in popularity because it's, again, good product. Sometimes it's about it's just looking at what they're doing. What Antimatter is doing, I agree with Marija. I would like to see liquidity. I'd like to see how it integrates with the rest of DeFi. I'd like to see if there's demand for these, because sometimes they're so complex. The two I looked at recently are TracerDAO and Antimatter. Antimatter is perpetual options. TracerDAO is the synthetic leveraged tokens. My sense is that TracerDAO I would not be so bullish on because I'm not clear. It's not clear to me that people will understand these products enough that they become popular. I think it was just so complex that most people would just get lost. Mm-hmm. Great opportunity for people doing arbitrage, though. It's a great product for arbitrageurs, but perpetual options, I think, are simpler. It's just insurance. So I think it could catch on. And if it does, these projects and these tokens, the underlying tokens, will do very well. Cool. So just get involved with the products, use it, see if you can make sense of it, and if it's good, and you think there's something valuable here, then you can place a bet. Say, hey, I think this is going to go higher.
Gotcha. Right. Well, I think we'll wrap it up there. Thanks for all three of you for being on this week's edition of the Wise Crypto Sunday Special.
Thank you, Chris.
Again.
All right.
Thanks, Chris.
That's going to do it for this week's edition of the Wise Crypto Sunday Special. Keep your eye on your inbox for next week's episode. Until then, it's me, Chris Coney, saying bye for now.